Welcome to TradeTheNBI.com. This is John. This report is for the 7th, and well, here we go. We're going to be in the final push before the election, and obviously you can see that we've had the sell-off that took place as the polls started to change, and I think that it's become pretty much toss-up, which does not fit within market expectations. This, of course, is not exactly what you would call a significant decline. I mean, if we just get some perspective to it back here, I mean, all we've done is retraced just a little bit to, well, basically what things were in July. So not anything to get freaked out over. There's a lot of prognostication about what'll happen if or if. It's all nonsense, because after the election, the market should be poised to move forward because there will be clarity and people have a clearer understanding. And at the end of the day, there still is no other place to put your money at this particular time. Likewise, NQ has seen a little bit deeper retrace simply because it was a little bit further ahead of both the S&P and the Dow. And there's the Dow. So are we seeing a change? No. I mean, look at this. It's right here with the orange, right in the middle between the two. We're either going to see a further decline in the relationship of the orange to long-term buyers here, the red DOC, and or even a crossover the green. We are reaching a level, minus 20 here on the red. That's getting to the point where you almost have your forced buyback, sort of like that dead cat bounce effect, that we're still continuing with the subtle decay. And for as many people talking about how many down days and most consecutive blah, 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 it's nonsense given how small the decline's been. So just pretend that you're not even listening to that. The rally on the euro, from the slight decay, you can see we ended up with the bounce. We dipped down towards the 7.5 right about there. Click that one with it. And then we reaffirmed it again now that we've completely moved below the steel under the 7.5. And now this magenta number also indicates that we've gotten into an overbought, and you can see that we had several days of positive extreme and near positive extremes right there in the yellow. It's easing off a little bit, which just means new money's flowing back into it, and basically we've recouped the dip, and we've moved back into the much tighter range, which was that 113 to 111 range, and it puts a square right in the middle of that. So it was a nice little shakeout move of scaring some people. The Brit exit being canceled certainly supports the euro a bit more. Economically, with the jobs increase, a move of interest rates towards December could put some pressure back down on the euro, so I wouldn't expect this to get too far out of control at this particular point. And bonds, obviously, there's a little bit of a flight to safety, given where things are right now in the election, and that's not surprising. Oil still having difficulty stabilizing simply because potential for greater supply, even with huge inventories because of the low growth policies, really becomes problematic, but it's also a benefit to inflation. Gold, secondary hedge. Now, some of this has to do with the election, but it also has to do with the potential of improvement in not just the global economy, but also pressures for wage increases and things like that. There's a growing consensus and idea that after this number of years, there is enough significant pent-up demand, and that there's going to have to be some form of increase in price structure that will result in inflationary constructs. This has been an ongoing battle back and forth. I think the likelihood of a Donald Trump win would certainly indicate skyrocketing for gold very quickly, simply because some of the intended policies will definitely result in greater growth, and greater growth certainly is going to accelerate inflation, and that would cause a significant bump. So if people are betting 3, 4, 5 months down the road, you would see an immediate impact from that move. Just from a practical standpoint, it's not suggesting anything other than to point out what the fiscal impact is. Now, so we had our nice little buy configurations come up. We ended up with some overbought status, and we had retraces that filled those back in. Then we finally get to the peak of DOC started popping in a little bit more, and then we ended up with orange moving strongly back in between the cyan and that, with the cyan leading, and that's typically bearish. particularly with the steel also caught below. And you can see the significant decline was merely a 100% retrace of the move. It went a little bit past that. We actually went and dipped all the way back down to match the previous lows of the day before. So it was much ado about nothing. And a lot of this was because some of the late afternoon, the polls started showing even further tightening, providing a path that was a little bit more than just, 5-10% for Donald Trump. And so that kind of altered the perception of things. And so people just wanted to be into a neutral stance going into the weekend. Obviously, there was a little bit of a boing that nothing major broke Friday against either candidate over the Friday afternoon. Doesn't mean that something's going to happen on the weekend, but it take one day at a time in this particular point. So still minus 20. That doesn't bode well for beginning turnaround at this particular point. So you just have to take it what it is. Just a couple of days left and we can be done with all of that, and then the next trade begins of a post-election and what it means for financials, for interest rates. A lot of different economic realities are going to be shifted. Not immediately, but the market isn't going to be looking at the immediate. It's going to be looking for down the road at the beginning of the year. And so it will start factoring some of that in early on. So people will be taking positions. And that has a net bullish effect, simply because there's just going to be a reallocation. You always hear about the amount of money on the sidelines and things like that. That's really not as relevant as yield and where you're going to find it. And the only place at this particular point, equities. Now, possible response to that could be gold. If that's the case, then that could put some more sustained pressure on the market if there is an alternative place for yield. And so we'll have to examine that as it develops. And that's a day by day, and we'll be able to get a longer term picture when we see it actually triggered. It hasn't taken place yet. So this particular point, equities is where it's at this particular stage of the game. As always, though, continue to look for me on the Skype chat, though, and trade well. We'll talk to you later.